All right. So Dr. Gottlieb, of course, was on Squawk Box earlier today, said he called the Delta variant, quote, the final wave, the final act of this whole deal, barring, of course, some new and unforeseen and more dangerous variant that would obviously be a game changer. The fact of the matter is, Joe, that you can still be bullish stocks without being as bullish as you perhaps once were. That's what Keith Meister told us last week when he was on the show on Friday. Let's listen to Corvex Capital's Keith Meister. We can react on the other side of that.
I think the backdrop is pretty high. Unemployment's down to 5.5%. There's huge savings on the sidelines. Interest rates are low. Yeah, sure. Could we have a 5% pullback or something associated with tapering? Yes. But in general, is the economy good? And did we get a reset? And are we probably earlier in the cycle than we should be here? Yeah. So, I mean, in general, it's hard to be bearish. Now, what keeps me from being so bullish is valuations. Stocks are not cheap, broadly defined, and we're up 18% this year. So we've moved a lot.
They mentioned the taper as well as one of the reasons why you can't quite be as bullish, Joe.
Mm-hmm. Yeah, I agree with everything that Keith said, and I think one of the other reasons why you can be bullish is because the rest of the world is so far behind us in terms of their COVID trends. And I would expect those COVID trends to have the same confidence that Dr. Gottlieb is exhibiting, where ultimately they'll reach a point where asset pricing ex-U.S. is going to recover. I think that's going to give a general lift to assets globally. But I agree with Keith. I think, yes, you could have a 5%, you could have a 10% correction tomorrow, but I'm not going to be moving out of the market on the expectation of that. And actually, if you did have a 5 to 10% correction, I think a lot of people would be coming on this network talking about that as a tremendous opportunity. Scott, you're early in the business cycle. Yes, we're anticipating, and I think that you absolutely should anticipate that the Federal Reserve is going to be tapering their asset purchase program, but they're not ending the asset purchase program. They have a historically high amount of purchases on a monthly basis, 120 billion. Even if they rolled that back to 105 or 100 billion, that's still a tremendous amount of liquidity that dictates you remain invested in the market.
Yeah, it's like you go from a water cannon's worth of liquidity to a fire hose, right? You're still right. Flush with liquidity in the system, which perhaps is why Credit Suisse's Jonathan Gottlieb today reiterates 2021 S&P target, the end of this year, 4,600, and initiates a 2022 target of 5,000. David Kostin over at Goldman Sachs says the S&P is going to reach 4,700 by the end of the year. Brenda, that makes sense to you?
It does. And I mean, as much as we can all be worried about valuation, there really are kind of three factors that I think give us less pause with where we are from a valuation perspective. One is just how low rates continue to be, even though they're ticking up a little bit here. But two is just the extent of the earnings beats that we've seen so far this year. And even though the market's up 19%, forward earnings projections have risen more than that since the beginning of the year. So we actually have seen valuation come down a little bit. And lastly, if you look at where the valuation is the most egregious, it's really in that group of top 10 stocks in the S&P 500. So plenty of opportunities outside of that group, which also speaks to everyone's comments about, staying within that those cyclical groups, not completely abandoning growth, but having that tilt towards more cyclical groups, I think makes sense.
Pete, you can say, what Meister says, is obviously true about where valuations are. The question is, can you justify where they are by virtue of the fact that earnings have been pretty darn good? And that's a bit of an understatement in and of itself. We're up 93% year over year thus far. Revenues are up 23% year on year, and you've had about 90% of companies report. That's the big question. Are valuations too stretched, or are earnings justifying where valuations are so the PE isn't as wide as it once was because earnings have improved to a very measurable degree?
Yeah, I think that on the basis of what we've seen so far, Scott, there's no doubt about that. I mean, I think the reality is some of these companies, and we said this a while back, multiple quarters ago, can they grow into where they are? Are their earnings, are they continuing to be able to grow their earnings to the point where maybe these valuations aren't as ridiculous as they might seem from the outside. And I think that's exactly what we've been seeing. When you look at a Microsoft or an Apple or some of these names, and I know Apple has lagged significantly relative to some of the other names, but when you look at some of these names and the moves that they made to the upside, across the board, you're looking at names that might be a little stretched from normal levels, but we are not in normal times. And in the times that we are in now, the growth rates have been absolutely extraordinary. And the bounce back and the speed of which, the velocity of it, has been extraordinary as well, Scott. So I think a lot of these names have absolutely grown into where they are right now. And I think, yes, PEs are a little higher maybe than they were historically, but given the backdrop, it makes sense to me. So there are a lot of different names out there where I do think you've probably got some names that are definitely in front of themselves, and they're overpriced. And we bring up a lot of those names all the time when you give me a little bit of flack about some of these great companies, but they have ridiculous, if they even have PEs.
I don't give you flack.
Now, on the other hand,
I don't give you flack.
just a little bit.
I just note the difference in how you play them, right? You refuse to own them as stocks, but you're sure as heck willing to play in the options market with them. That's all we know. It's just a different strategy of playing the momentum behind those names without putting yourself too much at risk.